41 companies have received approval to list so far this year, while 7 companies have been reviewed and rejected. The number of IPOs on the Shanghai and the Shenzhen stock markets is expected to increase rapidly in 2017, following the 227 that took place in 2016. Industry insiders like Tan Jialong estimate there could be as many as 400 companies completing IPOs on both exchanges this year, and that the total size of these deals could be between 200 and 250 billion yuan. And the queue for an IPO is still long. As of January the 19th, there were 629 companies waiting for CSRC approval.
Small and medium-sized enterprises are in relatively strong need of fundraising. Large enterprises have almost all completed their capitalizations. SMEs are more active and play more of a role in terms of economic transform and the modern service industry upgrade. Their performance will be better than the overall GDP growth. Therefore, allowing them more opportunities in the capital market on a fair basis will be good for the real economy.
Tan believes the increase in IPOs will primarily take place on Shenzhen's Chinex and SME boards. That may lead to the devaluation of some overvalued companies. Chinese investors trade new shares on their first trading days, as listing rules guarantee strong returns for new stocks. Shares of Ningbo Haitian Precision Machinery, for example, gained 2,186% in 30 trading days after its debut on Shanghai Stock Exchange.
The average valuation of this round of IPO is pretty reasonable, below 23 times to earnings, and that leaves some room for the growth in secondary market. Because of the room starting from last year, a large amount of capital crowded the secondary market to buy new shares. But more listings will add liquidity pressure to the entire market. And a tightening capital supply will naturally lead to fluctuation of the secondary market. If investors find that the potential gains originated from the gap between the primary and secondary are not big enough to make up for the losses from the secondary market, they will withdraw from both the primary and secondary markets.
Yang adds such enthusiasm is not a good sign for the implementation of the registration-based IPO reform. During the past decade, the Shanghai and the Shenzhen stock exchanges have implemented a series of rules, such as trading suspensions, to curb irrational buying on stocks' first day of trading. However, these efforts seem not enough to stop investors from speculating on the new shares. Ying Junyi, ICS for CGTN, Shanghai.